So how do you account for the cost of inventory? Generally, the cost of inventory includes the invoice price, any freight in other words, the transportation costs that you had to incur in order to bring it to your premises, your store, less any returns or any allowances, and subtract out any discounts that you receive. So another way to say this is inventory costs, any costs that you had to incur in order to bring that inventory to the site from which you're going to sell it and get it ready for sale. Notice that if I'm talking about a manufacturing business, we have three kinds of inventory. We have material costs, direct labor costs, and overhead costs of producing the product is included in the cost of inventory. So that's retail versus manufacturing firms' inventory cost components. When we look at periodic, remember periodic is where I have a purchases account that tracks all the purchases and returns of our inventory. So here's our template for success. When I buy inventory, notice I debit purchases and credit accounts payable if that purchase was on account. When I sell inventory, there's only one entry because it only tracks the sales price. It doesn't track the cost of the goods sold. So at the end of the period, notice we're going to have to compute what cost of goods sold is, which we said was beginning inventory plus purchases minus ending inventory gives us cost of goods sold. Here's a problem. Here we have Nick. It's buying Maine lobster on the 10th of October. So we're going to debit purchases for the gross price, $76,000, and credit accounts payable because this was a purchase on account. We also, or Nick, also bought Alaska king crab on the 11th, debiting purchases and crediting accounts payable. Nick paid for the lobster within the credit terms, which were 2, 15, and 30. So since he paid them October 20th, he got a 2% discount. Thus, we'll debit accounts payable for the full amount of the invoice, $76,000, but will credit purchases discount, a contra purchases account, for 2%, the part he didn't have to pay, and credit cash for 98%, or $74,480, the part of the purchase he needed to pay for because he paid within the discount period. Whereas the crab didn't get paid until October 30th, so that was after the discount period, so Nick didn't get the discount, so he just debited accounts payable and credited cash. Notice, again, under periodic, you must compute cost of goods sold, and notice that many companies use a combination of both perpetual and periodic, one to track the day-to-day dealings and the other for financial statement purposes. Notice that when we track inventory, that we have to assign the costs of beginning balance and purchases to the ending balance and cost of goods sold. And we do that with a variety of methods, and that's what we'll talk about next.